Just when things were looking up again, Troika Media goes and files a shelf offering. That probably cancels out the Genius Group takeover, it seems. Hi again, everyone. I hope you're all doing really well. Troika Media Group, ticker symbol TRKA, has been making waves in the stock market lately, and not all of them seem to have been positive. The company, which describes itself as a consumer engagement and customer acquisition consulting and solutions group, has seen its share price fluctuate sharply over the past few months. On Tuesday, April 11th, the stock fell by as much as 12% before recovering to about 9% down by the close of the regular session. This came after the company filed a shelf registration statement with the US Securities and Exchange Commission, which raised concerns among investors and as a consequence returned much of the gains that it had made in the previous session's trade. So what is a shelf offering and why did it have such a negative impact on Troika's stock price? Essentially, a shelf offering allows an equity issuer to register new securities without selling the entire batch in one shot. Instead, the issuer can sell portions of total securities over a 3-year period without re-registration requirements or penalties. This can be advantageous for the issuer in several ways. For one, it allows them to wait for more favorable market conditions before deploying new issues of stock. Additionally, it can save money on the cost of re-registration. However, there are some downsides to shelf offerings as well. The most significant of these obviously being dilution.
Say what?
Whenever a company sells new shares, it reduces the value of existing shares. This can be a major concern for investors as it can lead to a significant drop in the stock price, often being oblivious to when the new shares have been sold. As such, it can also make it more difficult for the company to raise capital in the future, as investors may be less willing to buy new shares if they believe that their existing shares are going to be diluted. So what does this all mean for Troika Media Group? Well, the company has been making headlines in recent months due to its volatile stock price. Despite suffering sharp volatility in Tuesday's session, the stock has gained roughly 140% since the beginning of the year. Last month, an investor placed article targeted Troika stock as a high-risk, high-reward growth opportunity, citing strong revenue trends and massive improvements in adjusted EBITDA as a bullish factors to consider. So there's still positive sentiment around the stock, and this mixed shelf offering doesn't necessarily change that. However, Troika's recent shelf offering has raised some concerns among investors. Specifically, it suggests that the company may be looking to raise more capital in the near future, which could dilute the value of existing shareholders, as we've been saying. This could be particularly problematic given that Troika is already facing several red flags according to the investment research platform Guru Focus. For examples, the company has been issuing new debt at an alarming rate, expanding its liabilities line item by $66.5 million over the past 3 years, and additionally, its Z-Score has slipped to 0.66 below break even, indicating distress and implying bankruptcy possibility in the next 2 years. Just to unpack it a little bit, a Z-score is a numerical measurement used in finance to help determine the financial health of a company. Specifically, the Z-score is a measure of a company's likelihood of bankruptcy. The formula for the Z-score takes into account several financial ratios, including profitability, leverage, liquidity, and activity. In general, a higher Z-score is better as it indicates that a company is more financially stable and less likely to go bankrupt. A Z-score above 3 is considered safe, while a Z-score between 1.8 and 3 indicates that a company may be at risk of bankruptcy. A score below 1.8 indicates that a company is highly likely to go bankrupt in the near future, which is where Troika Media finds itself. It's important to note that Z-scores is just one measure of a company's financial health, and it should be considered in conjunction with other financial metrics. Additionally, the Z-score is not foolproof and should be used as a tool, not as a definitive measure of a company's future prospects. So take what you will from that information about Troika stock. Moving on, while Troika sales trend is impressive with a 3-year revenue growth rate of 31%, its bottom line is a bit of a mess. The company's net margin has fallen to 14.54%, below parity on a trailing year basis. This suggests that extreme caution is necessary for Troika stock. So what does this all mean for investors? Well, it's clear that Troika represents a highly speculative entity, and as such, it may present an unacceptable risk to conservative investors. However, for those who are willing to take on more risk in the hopes of higher returns, Troika may still present an intriguing opportunity. There is still a lot to be hopeful for with this stock. I think there are good prospects for the company. Even after today, in the past month, Troika's shareholders still gained about 6%, which is about in line with the major indexes. So the market isn't necessarily trashing the stock at the moment. Anyway, what are your thoughts on Troika Media at the moment? Does the mixed shelf offering throw water over any potential retail rally in the stock in the near future, or is there still potential for it to pop again? Let me know your thoughts in the comments below, and until next time everyone, may the markets trade in your favour. Cheers.